Good morning, everybody. I'm just going to move this a little bit so that I don't have to shake my sort of look back all the time. So that'll probably be the easiest way to do this. It's a pleasure to be here, and what I'm going to do is talk to you about the economic outlook for the coming year, and then a little bit on the auto sector, given that that's a big sector here in Durham. I think the key point that I'll be bringing here to you is really, you just listened to Jim, and Jim was telling you, what can I do to get things moving? Well, that's fine, and I'm going to tell you that the environment that we're facing is a positive one, that the background is supportive of expansion and ongoing growth. And that's really the message that I'm bringing here this morning. So when we look at my charts, for example, the first one here shows global GDP growth, and the key point was we were growing about 5% per year through 2008, and then we went obviously through the steep slide, but we bounced back fairly nicely, and by early 2010 we were growing around that 5% pace once again. Since then, we've been moderating, and we basically started to improve in early 2013. You can see that little improvement on that line there. And then we were hit by the colder weather, slower activity in Japan, et cetera, because of tax hikes in April. But I think the key point as we stand right here, we're expecting growth to pick up. And so for this year, we're expecting growth in the order of about 3.2% on a global basis. As we move into next year, it'll be closer to about 3.7%. And that'll likely be the growth rate for 2016. So a pickup in activity, which is positive. The emerging markets had been the growth leaders, but they also went through some pace of moderation. And we think that is likely to start to turn around here again. In particular, what we do is we look at global new order activity, and you can see that it was generally sort of moderating through the middle of 2012, but then since then it has picked up. And industrial production typically follows that same pattern, and that was consistently the case through, I would say, late 2013, except that this year there was some moderation, and that reflects two things. Number one, the softness in Europe, largely because of the sanctions that were imposed with the problems with Russia and the Ukraine, but also the tax cuts or the tax hikes in Japan. And you can see that we had a clear bottom in August of this year. And that was, if you recall, if anybody sort of follows stock market activity, you remember back in September, October, we were all worried that we're seeing a significant slowdown. Well, lo and behold, part of that was temporary in nature, and now we're starting to see a bounce back in activity. More important, I think, is the fact that you're seeing the new ordering number still remain very, very high, notwithstanding this moderation in terms of the production side. So this is really the key leading indicator that we're focusing on. And so when you look at global growth moving into the next year, the key point is the trend is generally upward. So the U.S. next year will be growing in excess of 3% on a year-over-year basis. That's the first time since 2005. Canada, not as fast, but about 2.5%. The trend is generally upward. Look at the Eurozone. They had been negative on an upward path as well, not as fast as growth as is the case here in North America, but trending upward. And so that's the key message here is most regions of the industrial world are seeing stronger activity as we move forward. The developed nations, China, for example, is still going to grow by about 7%, so they will be the fastest growing. But in contrast to what we're seeing here, the faster growth, they'll be moderating a little bit. Same thing with respect to Brazil. They had gone through a significant slowdown this year. We'll expect a small improvement next year. India, similar to the industrialized nations, a general upward trajectory. And so that's the key message with respect to the outlook for 2015 and 16. And so some of the key indicators that we track, obviously employment growth is very important. And as you can see, global employment growth has been fairly decent coming out of the downturn, in excess of about 2.5% on a year-over-year basis. The U.S. has picked up, and we're basically growing close to 2% on a year-over-year basis in terms of job creation. But more importantly, what we're seeing is the leading indicators. For example, this tends to lead sort of both on the upside and the downside by about 6 months at least. And the point that's important here is you're seeing that it has picked up momentum. And so right now, the leading indicators are pointing to the strongest growth since early 2010. And so that's what's important. Other leading indicators, such as what's happening with bank lending, it starts to moderate as we go into a slowdown. What we're seeing is it's actually accelerating, both on total loans and in particular the C&I loans, which are basically used by businesses when they make their investment decisions. And what you're seeing is that that's picking up, and that's a clear leading indicator. One of the most important things that has changed in the last little while is really the improvement in the financial position of U.S. households. So this chart here, I'm looking at how much of U.S. households' income is being absorbed going towards energy and debt charges. And you can see when we headed into the downturn in 07, 08, it was basically close to 20%. Right now, and this is as of the third quarter, it's at the lowest level in more than 20-odd years. Okay, so that's positive. It's telling you that the U.S. consumers now have the ability to go out and purchase things, which was not the case previously. And as a result of that, you can clearly see that consumer spending has picked up. Now, we also know that oil prices have fallen significantly. That's not included in this number. And so once we get the fourth quarter numbers later on, you'll probably see something probably in the 14 levels. And that is, a further improvement from what we had experienced through the third quarter. Looking at the Canadian situation, something similar. So prior to the downturn, we used to have around close to 16% of disposable income going towards those two components. It's about 14% now. It's not as low as it was back in 2010, but it's fairly well below what is normal. So it's telling you Canadians are still in fairly decent shape, notwithstanding all the comments that you hear in the media regularly, which tend to focus primarily on the high debt levels. Yes, there are high debt levels, but the reality is that because rates are significantly low, it's not absorbing a large part of disposable income, much lower than what has been historically the norm. And as we look at what's happening in terms of trade activity, we're essentially a small country. We basically produce primarily to export to the United States. And what we're seeing is that through the middle of 2013, we've seen a significant improvement in export growth. So in looking at Canada as a whole, it's basically up close to 10%, and that's the best growth rate in a couple of years. Similarly, in Ontario, significant pickup. Once again, when we look at most of these charts, there's one thing which is consistent, which is a general bottoming in terms of most indicators, whether it was late 2012 or early 2013. So even global trade volumes, same type of thing. You look at retail activity. So these are purchases by domestic consumers. Ontario, Canada, the bottom was early 2013, and in both cases, it's picked up significantly. Looking at new orders for the manufacturing sector as a whole. So the US, the bottom there was early 2013, and you're basically seeing fairly strong order growth in excess of 5-6%. Canada, it lagged a little bit, but since late last year, and especially once we saw the dollar moving below 90 cents, we basically got a big increase in our new order activity. And you look at Canadian unfilled orders. This is the backlog of orders that companies have on their books that they haven't begun to produce yet. You're seeing double-digit growth. So that's telling you that there is significant demand. The orders have been put in place, but they haven't actually started working on them. So that's very good news for the coming year. When you look at the breakdown of the exports, from Canada's perspective, resources, energy, for example, forest products have tended to lead the way on the upswing. But what's interesting, especially in the last little while, is you've seen a significant improvement in terms of the export levels from the auto parts sector from overall manufacturing. And so it's consistent with that general improvement that we've been talking about. We've seen the orders come through, we've seen the exports begin to improve, and there's still a lot more to come. One of the other things that's very important, we went into the downturn in an environment where interest rates, these are short-term interest rates, this is what's controlled by the central banks, used to be 5 to 6%, while every single bank in the world slashed them to record low levels. In the US in particular, they've been slashed to a quarter, they've been maintained at that level. Since then, we're expecting the Federal Reserve, which is the central bank in the United States, to begin to increase rates by the middle of next year. Canada, probably not until 2016. But the point that's important here is look at rates where they were prior to the crisis. Even by the end of 2016, once the central banks begin to increase rates, they will still remain at least half of the levels that they had been previously. And that's one of the key things that's important. The central banks have done everything that they could. Now they're going to have to begin to change their policy a little bit, but they're going to be doing it in a slow way, and rates are going to continue to remain relatively low for a long period of time. One of the reasons that's possible is because inflation has been fairly tame. It used to be, 3 to 4% on average. It fell 1% or lower. It'll now pick up a little bit towards that 2% level. But central banks are comfortable with 2% inflation levels. That's generally their target. That's what they aspire to have an inflation rate which is roughly about 2%. So that is precisely the kind of environment that they want. So while they'll be raising rates a little bit, it won't be significantly so to damage the recovery. And somebody had talked about, I think it was the minister, when he was talking about one of the things that has been very important for Canada is financial stability. This chart, and I take it at all of my presentations, basically gives you a sense of financial stability or financial risk with the global financial system. And the point here is when we have this green line beginning to spike or beginning to increase, it's basically telling you that there are risks building in the financial system. So if we think back to the latest financial crisis, as recently as around the middle of 2007, you started to see these rates begin to increase significantly. So that was telling you that there were problems, and then obviously it culminated with the collapse of Lehman Brothers, and we had obviously the Euro debt crisis, 2010, 2011, but look where these rates are right now. These are basically, in this case, it's a TED spread. A TED spread is a 3-month Euro rate, and you're comparing the difference between that rate versus a 3-month T-bill. But you can use all different types of interest rate spreads or risk measures. And the point is that the system is financially stable at the moment. You hear problems. Yes, we have headline risk all the time. Yes, we're bombing the ISIL guys in the Middle East. Yes, there's problems in Ukraine and Russia and so forth. But the reality is those are headline risks. In terms of you look at what's happening to the financial system as a whole, it is functioning normally. And that's really what's key. So we're talking about general economic conditions improving, and we're talking about the financial system being stable to be able to support that. And that's what's important with respect to what I'm telling you is going on. Looking at some of the key indicators that we look at for auto sales, we put together what we call a leading indicator of U.S. sales. So it takes account things such as employment levels, income growth, some of those interest rate spreads that we talked about. And the important message here is that indicator right now is at one of the best levels since the early 1980s. So not only are U.S. vehicle sales improving, recovering from the sharp downturn, we expect them to continue to improve. And with respect to our indicator, the key point here is it leads both on the upside as well on the downside. And right now, it's telling us that conditions are healthy for the industry. And when you look at the level of production, the peak production in North America had been around